I've screened thousands of stocks and I've discovered the most high quality businesses in the UK. Today I have found a business that I believe has the most durable competitive advantage of any UK stock, and it is a stock that I believe every investor should consider owning in their portfolio. This stock has seen its revenue grow by 84% over the last 5 years. However, its market capitalization has grown by 115%, suggesting that the company has seen an increase in price premium from investors regarding the revenue growth. However, this is where the company gets quite interesting. When we look at profits and free cash flow, over that same time period, profits have increased by 105%, inferring that the market cap growth is actually driven in line with the profit growth. Free cash flow has grown by 230%, and as a percentage of revenue, free cash flow has gone from 19% in 2019 to 35% in 2023. Showing that free cash flow is actually growing at a faster rate than the revenue, suggesting improvements in efficiency and that it is reinvesting heavily in growth. Profit margins have remained consistent, but certainly peaked during the pandemic in 2021 at 33%, compared to 28.6% in 2023. This is because the business had a larger percentage of trade that was online and direct, as opposed to in a physical location in which they're able to have less costs. At first glance, it would appear that the company has fallen in return on capital employed, or ROIC, since 2019 from 75% to 62% in 2023. It's important to note that this is due to a greater increase in the balance sheet value compared to the growth in profits. Short-term debt can impact this figure, but they do have zero debt on the balance sheet. That said, this is a really impressive ROIC and has remained consistent over the last 5 years. Now, a huge problem that an unaware investor faces is share dilution. Over the last 5 years, they've seen an increase in the number of shares by 1.3%, which is very minimal and fantastic for long-term investors, considering this company does not participate in share buybacks. It goes to show that the management is aligned with shareholders and isn't diluting them willy-nilly. In the same time, dividends, however, have increased by 168%. When compared to the earnings per share figures, this is an increase of 64% in real terms. Investors should be cautious if investing in this stock for dividend growth, as it is unsustainable to grow at its current rate without significant increases in profit. So keep that in mind. Whilst they've had good dividend growth at the moment, going forward it's likely to slow down. This stock has a fantastic balance sheet with a debt to equity ratio of 0%. Furthermore, their cash position has improved by 207% over the last 5 years, which has fueled their quick ratio growth of 59% to 2.62. The quick ratio measures a company's ability to meet its short-term obligations with its most liquid assets, hence why the cash has pushed this metric up. Anything above 1 is deemed as good. The current ratio highlights that this business has 3.61 times more current assets than liabilities to cover its debts, again showing its strong financial position. A huge mistake that I've made in the past, which has cost me nearly £20,000, is disregarding valuation. When we look at the price to earnings ratio, we can see that this stock is valued at 26.3 times earning, which is closer to the 52-week high and double that of their 52-week low. When compared to the UK market average of 11.6 times, we can see how investors have richly valued this business, especially over the last year. I would be extremely mindful of purchasing shares at this current price, but would certainly keep a keen eye on this stock to watch for any opportunities should the stock drop in value in the future. This company is the largest and most successful in their niche. They have strong brand recognition, high quality products, and a vertically integrated business model, meaning they control all aspects of the supply chain. They also have a strong community outreach, which is boosted by their stores, third parties, and online, where they can promote their appealing brand to customers. The management is strongly long-term oriented and is very shareholder friendly, as shown by their commitment to distribute truly surplus cash as dividends. The brand also has a valuable portfolio of intellectual property, giving them a distinctive advantage and allows them to generate revenue from a variety of sources, including royalties, licenses, and merchandise. When factoring in the high switching costs a consumer would face to transfer to a competitor and the large network of hobbyists in the current player base, it means this company has an incredibly strong moat. Based on my discounted cash flow valuation, I would personally be interested in purchasing shares of this stock at £65.90, which which is a discount of 39% from the current share price of £107.80. The stock ticker is GAW. The business is called Games Workshop and it has a current dividend yield of 4.1%. To build a dividend portfolio that pays you every single month, click here.